Hello, this is Will Allen with Centera Capital. Well, as we approach late January, we're back with the market update, and we have some key economic data that has been released this month that we wanted to share with you. We're going to take a look at the recent changes in consumer sentiment. And then lastly, we're going to talk a little bit about the start of earnings season because it is here and it's our favorite time of the month because of that. Let's dive into it. So we're going to get started by taking a look at a piece of economic data that is pretty remarkable if you think about it, and that is initial claims for unemployment insurance. Now, this is, again, when someone's laid off, they go to file for unemployment insurance. That's what they're counting here. And remember, at this time last year, when 90% of economists thought that there was going to be a recession in 2023, this was one of the categories that we were closely watching because we said as long as the jobs market is holding up, we don't see a recession taking place. Well, now we're here at the start of 2024. There was no recession last year, and most economists now are not projecting one even in 2024, but we're still watching closely for signs of economic strength. So the most recent data came out last week, and we'll put up the chart. You can see there was 187,000 new people filing for unemployment insurance. What was remarkable is that was the lowest number since September 24th of 2022. And as you can tell looking at this chart, the initial claims have stayed in a very low range basically for the last 2 years because a lot of people believe that this would start to do a U and start with going up, and that just hasn't happened. So we're really glad to see, again, it looks like companies just don't want to lay off workers, and that's a positive because workers who have jobs, the consumer who has jobs, like to spend money, and that can be a really positive for the economy. Now that's our first point. Let's shift to point number 2. So one of the things that we talked about in some of our videos late in 2023 was this idea that consumer sentiment had been pretty low, even though the stock market was doing well, the jobs market was strong like we talked about, consumers were spending money, but yet consumer sentiment was still low. We basically, did our research and came up with the fact that the main reason for that was just that prices went up so much when inflation hit hard in 2021 and 2022 that price levels were really high, and that was weighing on the consumer. Well, one of the things that we noticed, the rate of inflation has come down, but price levels were still pretty high. But consumers are starting to become a little more comfortable here, and they are not viewing inflation quite as negatively. And why do we say that? Because let's look at these two charts. So the first one there shows consumer sentiment, and you can see it jumping up to 78.8, its highest level since July of 2021. So that's nice to see because when consumer sentiment improves, typically spending picks up by consumer, and that's really good to see. But let's put up the second chart, and this looks at this is a survey through the University of Michigan. They ask consumers, where do you think inflation is going to be over the next year? And what you'll see here is that this has fallen dramatically here over the last couple months, and it just hit 2.9%, the lowest level since 2020. So you have to go back some time since consumers, their expectations of inflation had come down to this kind of level. So this is a positive. We like to see this get down even lower. Pre-COVID, this was between, 2.3 and 2.8% most of the time. So we want this to go lower. But this is a positive here that inflation is not as such a concern here to consumers as it has been over these last 3 or 4 years. Okay, our next economic data point is taking a look at the Fed and taking a look at what the market thinks as far as the Fed cutting interest rates for the first time. Just as a reminder that we talked about late in December that the Fed's meeting in December, which was their pivot meeting, when they went from talking about potentially raising interest rates to letting us be known they were done with their rate hike cycle and they would be cutting rates in 2024. So what we're going to put up is the odds that the Fed cuts rates for the first time at their March meeting. So we'll put that chart up, and what you'll notice is that the odds of a rate cut in March were about 40% when the Fed had their meeting in December, and that it went from 40% up to 90% in the week after the Fed meeting. So the market participants were saying, hey, the Fed's going to be cutting here in March. But you'll notice that over the last couple weeks, that percentage has dropped and gone from 90 down to around 40% now, back where it was the day of the Fed meeting. So the reason for this boils down to the fact that the economic data has been really good of late, and the market is saying, hey, the Fed really doesn't have to cut as soon as March. The economic data is still strong. Let's project that the Fed will be cutting in May. And so that probably fits more with what we think, because we're more in the camp that the Fed will be cutting probably closer to 3 or 4 times in this year, unless something crazy happens later in the year, that is. The market was projecting 6 rate cuts. We said that's probably too many, so this is getting the market more in line, closer to that 3 by kicking the first meeting back to May. We wanted you to see that because this is a big change from late December. So the last point isn't an economic data point so much, but we're talking about earnings season because we now are in the heart of it. Every quarter, there is about a 4-week period where the lion's share of companies in the United States report their earnings, and you get to find out what has happened in the previous 3 months for those companies, plus what are their outlook for the current quarter and the rest of the year. So far, we've heard from a lot of banks, both large and small, some industrial companies, and then a scattering of others. And I would say early reports have been good, have been solid. Companies' outlooks have been that 2024 should be a good year. And one of the items I was really listening for was on the financial side, was from the regional banks. Because if you remember back last year at this time, especially in February, March, when you had Silicon Valley Bank go under and Signature Bank go under and some other regional banks in real trouble, there were some who said, hey, we could have a mini financial crisis on our hands. That did not occur, and the fact is these regional banks have had really strong reports, and they are in a good place. That is good news for 2024. We will keep listening in the weeks to come. Next week, we get a lot of tech companies, and those are very, very important to driving the market, so we're going to be listening to them, but there's plenty other companies later on this week that we'll be listening to, and we will be reporting back to you if there are any key things that you need to know. Well, that about does it for this update. Again, thanks for watching. Don't forget to like and subscribe so you never miss a video, and we are still looking forward to 2024, a good year, and thanks for watching. Thanks so much for watching this video, and if you are new to Cetera Capital or you have just started to see a couple videos, head on over to CeteraCapital.com. Under the Contact Us page, you can reach out to us and have a phone call with a live person. And the fact is if you're one of the folks that you just don't get communication from your advisor, or you don't get market updates, give us a call. We'd love to talk to you and see if you're a good fit. Thanks a lot and have a good day.